In this video, I would like to discuss the characteristics of a high volatility market. As an investor, you need to be conversant with the characteristics that indicate that a market is undergoing high volatility. So, high volatility markets are characterized by significant price fluctuations and an increased uncertainty. So here are key characteristics of a typical high volatility market. Number one is large price swings. Large price swings. These have to do with frequent and wide fluctuations. So high volatility markets exhibit frequent and large price changes within a short period, often moving up and down by a significant percentage in a single day. It moves significantly up and down in a single trading day. So it also, have that increase in market noise. The rapid changes in a price can create a lot of noise, making it harder to discern long-term trends from short-term movements. Number two is elevated volatility index, the VIX, VIX, elevated volatility index. So in this case, there's that particular fear gauge, and it's called fear gauge. The VIX, often referred to as the fear index, tends to spike during periods of high volatility, indicating increased market uncertainty and fear among investors. Investors become very fearful. And so you equally have market sentiments. The high VIX reflects nervousness and potential panic in the market, leading to a more erratic price movements. Number three is increased trading volume. Trading volume. So in this case, you have higher activity. So higher volatility markets typically sees a surge in trading volume as more investors and traders react to price movements, trying to capitalize on short-term opportunities or to protect their investments. It equally incorporates liquidity challenges. So while overall volume may increase, certain assets may experience periods of illiquidity, making it harder to execute trades at desired prices. It becomes very difficult to buy or to sell stocks at the price you so desire. Number four is unpredictable market behavior. Unpredictable market behavior. This has to do with rapid trend reversals. So markets may change direction suddenly and unexpectedly, making it difficult to predict future movements based on past trends. In this case, you can hardly accurately predict future movement based on past data. So you equally have emotional decision making. So investor sentiments can swing rapidly, leading to emotional decision making and contributing to further market instability. Number five is wider bid-ask spread. Wider bid-ask spread. So in this case, it has to do with higher cost. The difference between the buying price, which is called the bid, and the selling price, known as the ask, tends to widen during high volatility, increasing transaction costs for investors. So that bid-ask spread is kind of wide, and as a result, transaction cost becomes equally higher. So you have liquidity risks also. So wider spreads can indicate lower liquidity, as fewer market participants are willing to take or to trade at current prices. People tend to withhold themselves from trading, which will lead to illiquidity. No much trading is happening in the market. Number six is correlated asset movement. Correlated asset movement. In this case, we have reduced diversification benefits. In high volatility environments, asset classes that typically move independently may become more correlated, reducing the effectiveness of diversification, as a risk management strategy. You discover that different asset classes, instead of behaving, in different pattern or formats, they tend to behave in the same form, same format, same pattern. And so in that case, the benefit of diversification, becomes highly minimized. Number 7 is um number part of number 6 is that particular flight to safety. So investors may flock to safe havens like gold or government bonds, causing these assets to move in opposite directions to riskier investments. Number 7 is news-driven market reactions. News-driven market reactions. In this case, you have sensitivity to headlines, to headline news. So market becomes highly sensitive to news events, economic data releases, and geographical development, leading to sharp and immediate reaction in markets, in asset prices. Not only that, you equally have, a tendency to overreaction. The market may overreact to both positive and negative news, amplifying volatility and creating exaggerated price movements. The market tends to overreact to news headlines in this case. So please subscribe to this channel and like this video. Make a comment in the comment section, as it's necessary. Number 8 is increase short selling activities. Increase short selling activities. So people tend to incorporate that bearish bets in their strategy. During periods of high volatility, it's often an increase in short selling as traders bet on the declining price, which can exaggerate downward pressure on stocks. When stocks are plummeting, at a higher degree, short sellers will buy stocks with the belief that stock prices will keep on going lower. As stock prices go lower, so they benefit from lower prices. But if the market reverses and the stock price goes up, they will lose tremendously. That's one of the hazards of short selling. Your upside potential is limited. It can't go beyond 100%, sort of, if I'm not mistaken, but the downside potential is unlimited. Our upside potential is capped. It's limited, but downside potential is unlimited. So you equally have risk of short squeezes. High volatility can also lead to short squeezes, where short sellers are forced to buy back shares at higher prices, causing rapid price spikes. Number 9 is higher risk premium. So in this case, there is demand for compensation. So investors demand higher returns, that's risk premium, to compensate for the increased risk associated with volatility markets, leading to more cautious investment behavior. They will demand a risk premium. What do I get from this risk I'm undertaking? So there's also volatility risk. The uncertainty associated with high volatility markets, often leads to greater risk aversion, affecting, asset valuation. It's really quite risky. Volatility introduces risk, and that will equally, affect, how the market value assets. Number 10 is potentials for systemic risk. Potentials for systemic risk. In this case, systemic risk is a risk that is associated with the entire system. In this case, so we have a market instability. You have prolonged period of high volatility can strain the financial system, potentially leading to broader economic impact or systemic risk of if not properly managed. It can affect an entire financial system. So you have what is called margin calls. It's related to margin trading. So increased volatility can lead to margin calls for leveraged investors, forcing them to sell assets and potentially target, triggering further market decline. People that borrow money to invest, when the market goes down, and the prices of equity, plummets, their brokers will give them what is called a margin call. You'll be asked to either add additional capital or you sell your holdings to be able to do what? To be able to balance what you are owing your broker that gave you the loan in the first instance. So this increased selling pressure to meet up with margin calls will even force the market to go down the moon, to plummet the moon. So in summary, high volatility markets are markets, are marked by large and frequent price swings. You have elevated, VIX, index, increased trading volume, and unpredictable market behavior. So it equally incorporates wider bid-ask spreads, correlated, asset movements, and news-driven reactions are also common. So in this case, investors may face higher, transaction cost, greater risk premium, and potential systemic risk. The entire system may be exposed to risk. So understanding these characteristics can help investors to navigate and manage the challenges of higher volatility markets effectively.